Here's a clear breakdown of the new pattern day trader PDT rule change that just passed and what it means for day traders. What just happened? The U.S. Securities and Exchange Commission approved a rule change that eliminates the traditional pattern day trader PDT rule. This is a major shift because the PDT rule has governed retail day trading for decades. Past the old PDT rule before the change, under the old system, if you made 4+ day trades in 5 business days in a margin account, you were labeled a pattern day trader. You had to maintain $25,000 in your account. If you fell below $25K, you were restricted from day trading. These rules came from FINRA Rule 4210 and were designed after the dot-com bubble. What the new rule changes? The new regulation does 3 big things. 1, removes the $25,000 minimum. You no longer need $25K to day trade frequently. This opens day trading to smaller accounts. 2, eliminates the pattern day trader designation. No more counting 3 trades versus 4 trades. No more automatic account flags. 3, replaces it with real-time risk-based margin rules. Brokers will monitor intraday risk instead of account size. If your positions become too risky, they can restrict trades, issue margin calls, require additional funds. What this means in practical terms: you can now day trade with less than $25,000, make unlimited day trades depending on broker risk limits, scale in out more freely intraday. But there's still control. Brokers will track real-time exposure. High leverage or large size relative to account may still get blocked. Risk management shifts from fixed threshold, dynamic controls. Hashed example: old rule, $5,000 account, you make 3-day trades, okay. 4th trade, account locked, PDT violation. New rule, $5,000 account. You can keep trading, but if you take oversized positions, broker may restrict you based on risk. Transition period. There will likely be a phase-in period as brokerages implement the new system, and platforms must update their margin frameworks before fully removing PDT restrictions. So you may not see it instantly on every broker. Why regulators changed it? Regulators said the rule was outdated and wanted to modernize day trading oversight using risk-based monitoring instead of a flat dollar requirement. Big implications for traders. Pros: smaller accounts can actively day trade. More flexibility scaling in out. No more 3 trades only. Limitation: easier to compound small accounts. Cons: easier to overtrade. Brokers may tighten leverage dynamically. Risk management becomes more important. The 25K PDT rule is effectively gone, replaced by real-time risk-based margin controls. This makes day trading more accessible, but not risk-free. Brokers will still limit you if your trades exceed acceptable exposure. Here's a full breakdown of all 3 areas you asked for: how this changes small accounts, best strategy now, and which brokers may implement first. How this changes small account strategies. The biggest shift is frequency is no longer restricted. Risk is. The SEC approved change removes the $25,000 minimum and replaces it with real-time margin tied to exposure, meaning brokers will monitor your intraday risk instead of counting trades. This creates several important strategic changes. 1, scaling in and out becomes viable. Previously, small accounts had to pick one trade carefully. You couldn't trim, re-add, or scalp multiple times. Now, you can take partial profits, re-enter on pullbacks, trade multiple setups per day. This is huge for momentum day trading and aligns with how experienced traders operate. 2, compounding becomes faster. Before, 3 trades per week limited growth speed. Now, you can compound daily. More opportunities, more learning reps. Smaller position size per trade becomes viable. 3, risk management matters more. Since brokers monitor exposure, oversizing may get blocked. Too much leverage may trigger restrictions. Fast losses can reduce buying power intraday. The new environment rewards controlled sizing, not just aggressive trading. Have best approach under the new rule. These approaches tend to fit the new structure better. A, high probability, small size scalping. Take multiple small wins, avoid oversized positions, use tight risk. This works well because you're no longer saving trades. B, scale in trend trading. Example, buy starter near VWAP, add on confirmation. Trim into strength, re-add on pullback. This was difficult under PDT, now it becomes optimal. See opening range breakout with partials. Instead of all in, all out, you can take partial at first target, hold runner, add on consolidation. D, reduce size, increased frequency, better structure, risk 0.5% per trade, take 5 trades, let probabilities play out. This lowers emotional pressure, which brokers may implement first, based on early announcements and market reaction. Likely fastest adoption, Robinhood, Webull. Both platforms jumped after the announcement, and Webull indicated it plans to remove PDT restrictions once the rule takes effect. These brokers rely heavily on active retail trading, so they benefit the most. Moderate rollout, TD Ameritrade, now under Schwab, E-Trade, Fidelity. These tend to move slower because of larger risk departments, more conservative margin policies. Potential phased rollout. Some brokers may remove trade count limits first, then introduce dynamic margin caps, then adjust leverage tiers. What will likely replace PDT in practice? Expect something like max position size based on account equity, intraday buying power reduction after losses, real-time margin checks before order fills. Example, $5,000 account. Broker may allow $10,000, 15K exposure. If you exceed, trade blocked. What this means for your trading style. Given your focus on SPY direction, momentum, intraday setups, this change helps you follow market trend more actively, trade pullbacks instead of one-shot entries, scale with SPY strength or weakness. You can now trade with the market trend repeatedly instead of rationing trades.